Hello, welcome back. I'm Ben Thompson. This is India Global Week, and we're going to continue our conversation looking at India as an investment destination. The country retains its crown as one of the top foreign direct investment destinations. But is now the time to bet big on equities, given all the global turmoil? Who's going to call the bottom of the market and what happens next? So to discuss that and to introduce his panelists, please welcome Amul Pandya, who is Head of Business Development at Ocean Dial Asset Management. Amul, good to see you. Thanks for chairing this next panel for us. A fascinating conversation, one that everyone wants a few answers for. So I'll hand over to you and let you introduce your panel.
Great. Thank you very much, Ben. And thank you, everyone in the audience, for tuning in to learn a bit more and maybe form an opinion or change an opinion on Indian equities as we stand today. So with me is my colleague. I'll start with my colleague, Gaurav Narain, who's sitting in Mumbai. Say hi, Gaurav.
Hi.
He's Ocean Dial's co-head of equities and is a portfolio advisor for the India Capital Growth Fund, which is a closed-ended investment trust that is trading on the London Stock Exchange that specifically invests in small and mid-cap Indian equities. Gaurav's been in the Indian markets for about 25 years. So he's based on the ground in Mumbai, and he will be part of the kind of he'll be the Indian specialist, particularly on the ground, on the panel. And then zooming out slightly to look at emerging markets in Asia and provide that perspective, we've got Carly Moorhouse from Quilter Cheviot. Say hi, Carly.
Hi, everyone.
Hi. So Carly is on the fund research team at Quilter Cheviot and is in charge of the Asia and emerging market fund research team. And Quilter Cheviot runs £23 billion in assets. And finally, from the broadest perspective possible, we have Brad with us. Say hi, Brad. Brad Barth.
Hello.
So Brad works for Grandeur Peak Global, which is a stock picking firm, a global stock picking firm that invests in equities all over the world. They manage about $4.5 billion, and Brad is deputy CIO. And before I finish Brad's intro, I want to say a special thank you to him because he's dialing in from Utah, and it is very, very early in the morning in Utah. So that shows real commitment for the India Global Week. If there is any way of showing more commitment, please let me know. So the panel, we're here to basically ask what will reignite international investors' appetite for Indian equities. And in the name, I think, is an assumption that Indian equities have not been particularly popular over the last few years amongst global investors. And I just want to kick off basically the conversation. Gaurav, it makes sense starting with you as the India specialist. So let's say it's been over 5 years since Narendra Modi became Prime Minister of India, and he arrived understandably with a lot of hype and a lot of promise and a lot of potential. And the international global investment community, who don't look at these things in huge amount of detail as maybe they should, maybe did the equation that, Narendra Modi is good for equities and he's good for growth. But if I have a very kind of minor look at, or high level look at the data, over 5 years, the BSE 500 has compounded in dollar terms at 1%, and GDP growth has kind of gone from around 7% to a pre-corona level of below 5%. So has it been worth it if we just look at the past before we start looking at the future? Can you just take a look at some of those concerns?
Yeah, I think the disappointment on India has really been on the growth side, and you've really hit the nail on the head. That India, you would have visualized on a worst case basis would grow at a GDP of at least 6%. And the sort of reforms which Mr. Modi was putting in place, you are actually structurally trying to take it to a 7 to 8% GDP growth going forward into several years. In that extent, while the reforms really have been put in place, and to that extent he's made some incredible reforms in a short span of 2 years itself, I think what was unanticipated was some of the after effects of the reforms. It really led to a liquidity crisis in 2018 and the failure of one or two large non-bank finance companies. really brought in a lot of risk aversion in the system. And that really, just when you were seeing the economy take off on the growth side, a liquidity squeeze for almost a month really pushed you back. And I don't think that was handled too well in the initial phase of the first 2-3 months. And that really set you back. But having said that, structurally, what's been done over these last 5 years is really positioned you to really take off to a growth phase, which I would say will sustain at a fairly high pace over the next few years. And when I say a strong growth, you're actually talking about a 7% plus GDP growth, which is sustainable. So I would say the ingredients are in place, but you've always had a few setbacks, largely on the financial system not being able to manage it. And you've had a period of de-risking. So today, when you're looking at the economy itself, the balance sheets of corporates are fairly strong because there's been a whole deleveraging phase. So it's fairly efficient to take off on the growth phase. But having said that, the last 5 years compounded earnings growth of the market has just been 2%, which is a historic low. And the trigger really is getting this growth back on. I would say the ingredients are in place, but really now you need a bit of a favorable environment to push you back.
So are you bullish, would you say, for the coming 5 years versus the past 5 years?
I would say so. I think we're just going through this. COVID has pushed you back a bit, but I would say all signs point that the economy, the macros are fairly healthy in one sense, which has been put in place. And it's just a matter of, overcoming this phase of COVID. And I would say from the second half, you'll likely start seeing things pick up fairly dramatically.
Okay, so I'm just going to flip to you now, Carly, because I want to zoom out a little bit and look at India from the context of other emerging markets and Asia more generally, which is what your specialism is, obviously. And I'm going to zoom out in terms of time horizon. We're going to stick to looking at the past before we look at the future. And if you just look at some numbers over 15 years rather than 5 years, India has done 6.7% annualized in dollar terms versus the emerging market index, which has done 3.8%. And if we go even further back, India has done double the emerging market index in dollar terms. So it's done just over 8%. So if you're a truly long-term investor with a, significantly long time horizon, surely, India versus emerging markets, there's only one winner if you were to position yourself back 15 years ago.
Yeah, well, it's just for the diversification aspect. Over the very long term, India, as you said, has performed very well. But, not every investor and client is as long term as that, unfortunately. If you only had a 5-year time horizon, then being invested in India maybe wouldn't have been the place to be. So, from my perspective, and the clients that I look after, it's really about managing these allocations from a risk perspective, not just return perspective, and over different time horizons, really. With broad EM funds, you get exposure to a number of economies and trends within them, and you can tactically dial those up and down depending on factors such as the macro backdrop, political situation, currency, that sort of thing. But yes, if everyone had as long a time horizon as 15 years, then putting everything in India might be a good idea from a return viewpoint. However, unfortunately, that's not the case. And for us, client outcomes are paramount.
So you obviously see a lot of emerging market funds and a lot of Asia funds. And it'd be interesting to hear how they are positioning themselves in terms of their India exposure. Is there a general broad overweight, underweight, or is it still a very mixed bag? And how does that compare to your opinion as to where they should be when it comes to India?
Yeah, it's still quite a mixed bag. I think obviously what's happened this year in terms of valuations has helped a lot. I think in terms of emerging markets in Asia, there are parts of both which are looking attractive. In terms of the virus, we're seeing a divergence between North and more developed Asia compared to South, more emerging Asia and Latin America in how the virus has been dealt with and the responses that governments have made. So looking at places like North Asia, like Taiwan, South Korea, Hong Kong, China, they've contained the virus very well. And where there have been spikes in cases, like we all saw in Beijing recently, they brought the numbers back down quite quickly. So these areas are definitely in the first in, first out camp. And here, this is where you've got more clarity, which obviously investors like. We can see their economy is getting back on track and normalized viewing. So there's lots to get excited about. However, in the developing world, so places like India, there's still a lot of uncertainty with regards to how the virus is going to play out. Case numbers are still not in that downward trajectory. And we know that continuing with a strict lockdown, like some places have seen, isn't feasible for the long term. Luckily, in the developing world, populations are a lot younger than countries that have been hit hard. So, here in the UK and Italy, for example. So hopefully that will help. But there are a lot of variables. And as I said, the uncertainty can make investors nervous. So, many are approaching places like India with a bit of caution still. That's not to say that there aren't some great opportunities to be had there, especially for long-term investors. And given where valuations have gone, investors have been able, as I said, to get those high-quality companies that they've had their eye on for a long time at reasonable prices. However, over the short to medium term, it could get a lot worse for places like India. So, you can see why many are understandably showing a preference to allocate towards where there's less uncertainty and a faster return to normality.
Yeah, that's very interesting. So kind of caution in the short term, and exactly. maybe ramping up from there on. Brad, I just want to bring you in because you're probably the only person on the panel who doesn't have to look at India at all if he doesn't want to. Carly, to a lesser extent, to me and Gaurav, who are full-time India investors, and Carly probably can't get away from India all the time throughout her working week. But for you, you've got every company in the world to look at in the public equity market. And so firstly, I guess the obvious question is, do you have exposure to India, and versus any benchmark that your investors might compare you to? Are you broadly overweight your exposure or underweight, or how are you viewing the market from an opportunity perspective?
We do have we do have exposure, and I would characterize our position as a broad overweight position across our fund.
And I guess what would be interesting, again, this is all looking at the past before we look at the future. When you're looking at the opportunity set and you're screening for new companies, new ideas, how often is an Indian company coming up on your radar screen from a quantitative perspective? And then when you're adding your kind of qualitative work on top of that, are you, what reasons generally come up when you remove or add Indian companies when you're looking at new ideas for your portfolios?
Right. So you're right that we don't have to be exposed to India. We don't have to be outside of our dedicated emerging market fund. We don't have to be exposed to emerging markets if there's not a good bottom up reason. But there are about 10 emerging market countries that we do invest in, and India is one of them. I would say, so we have, we adjust our Indian universe, for liquidity and transparency and so forth, and about 40% of that adjusted universe has been quantitatively interesting enough to warrant further diligence on our part, and so that's translated for us over the past several years into about 1,200 formal touches with about 250 Indian companies, and that bottom up process, going back to what Carly was saying, with a long view in mind, has resulted in a pretty consistent overweight position, and we do see, relative to other opportunities in the emerging world, more, obviously outside of China, the largest breadth of opportunities in general, but within that population, a higher percentage with acceptable returns on capital, and relative to other opportunity countries, much stronger capital distribution preferences in the form of dividends or otherwise, and so that bottom-up process that led us to a pretty consistently overweight position.
Yes, I mean, we always argue when we're pitching India that you've got a plethora of really high quality companies to invest in versus other countries. But, I just was looking at some statistics in terms of the global equity, benchmark. So let's take the MSCI All Country World Index, for instance. And, Australia, the Netherlands, Switzerland, South Korea, they've all got significantly bigger exposure as countries in the benchmark versus India, which is, at the moment, the fifth biggest economy in the world, growing somewhere faster than these other countries and with a much larger population. And you in your investment process seem to have taken a considerably different stance to the benchmark from that perspective by having, more countries, more companies from the India opportunity set. Why do you think you're so different, or why do you think the benchmark is wrong, or why is it so underweight? It's got a 0.8% weight to India, which to me, feels intuitively wrong if you're trying to look to the future. Right.
Well, yeah, I think we share your intuition, and the fact is that we're highly quality sensitive, and quality is all about long-term sustainability of value creation, and the growth longevity attribute that Indian companies have almost by definition means that if you can find something special, then all things equal, you would prefer to be you would prefer to be in India versus some of these lower growth or lower growth countries or countries with less of an underpenetration thesis. And so and you know what, it's hard work to identify. You've got to do a lot. I referenced all of those visits that we've done in order to find those special companies that are taking advantage of that demographic dividend, or however you characterize it. It's a lot of work, and so we feel like we've put in that work. We have a lot of respect for a wide range of Indian management teams that we've been able to get to know over time, and we think that we think that there are good things to come from that subset of the universe.
Okay, I just want to switch to thinking about the currency very quickly. Gaurav, one of the challenges I think international investors have is that the rupee's got two characteristics. Firstly, because India's been historically a high inflation country, it is a weakening currency. But secondly, because it is an emerging market, it doesn't weaken steadily in a predictable way. It goes through long periods of stability, and then it has a step fall, with a 15-20% collapse or depreciation, which I think puts a lot of people off, because whatever returns that you're making as a stock picker in the market often get eaten up by a weakening currency. Now, looking at some numbers, India's currency in the coronavirus crisis has done very well, actually. It's held up remarkably strongly, which you would have expected in history for it to have not done so. Do you think the currency is turning a corner, or is this a temporary phenomenon? Question one. And then question two, if it is turning a corner, which I hope you say it will, it is, then do you think that's something that could reignite Indian global investors coming into India?
Yeah. Actually, if you look at numbers, over the last 15 years, the currency on an average has depreciated about 3% per annum. Yes, as you mentioned, there are step jumps, but structurally, it's really not a currency which has depreciated significantly over time. Having said that, a lot has changed in these last 5 years, and when I mentioned the macros have improved, today you're possibly sitting on your highest ever forex reserve there, well in excess of $500 billion, And one of the reasons is that you are getting a lot of foreign direct inflows into the country. Over the last 5 years, every year you've averaged between 30 to $40 billion of FDI flows. This is not foreign portfolio flows. So this is long-term money coming into the country. Secondly, what's also changed is oil. Our biggest challenge is we've always had a current account deficit, largely because of we import almost 80 to 85% of our oil. Now, if oil prices stay at the current levels, in fact, for the first time I've been around, we've actually gone into a current account surplus. So actually from your Forex position today, if things stay the way they are, I won't be surprised if we actually have an appreciating rupee. In fact, what you're really seeing today is that the Reserve Bank of India is trying to stop the currency from appreciating a bit too much by intervening in the market. So it's structurally you're seeing a lot of investments coming into the money. So the capital account coming in is fairly structural in nature, and I don't see that change. So while we've had a 3% depreciation over time, my sense is you may see it flatten out a bit going forward. Currently, we are actually in a position of deep strength, I would say.
Okay. Carly, just the two things. One, any response to what Gaurav just said, or any thoughts on currency versus other countries that you look at? That's question one. And then question two, I just want to touch upon the kind of digitization story, if that's okay. So, India's has a very big population, but it's maybe not always taken advantage of its demographic dividends. But now that there seems to be a big digital ecosystem in terms of smartphone penetration, data provision, and all of those things, the combination of a big population and a digitally enabled economy could be a very powerful combination. But how does the digital story, from that perspective, stack up versus other countries that you look at and you compare? So two questions in one, if that's all right.
So I'll just start with the currency. I can't disagree with Gaurav. I'm not an expert on the Indian rupee or anything like that. But it has been, the weak currency has in the past put investors off alongside very high multiples. So a strengthening of the rupee over time would be beneficial, obviously. In terms of the digitization, as you said, they've got such a large and young population, and just across the board, the domestic consumption trend is and could be huge there. It's just about bringing all of those things together, and you do see some extraordinary numbers in terms of internet penetration and how far behind other countries it is. So the growth trajectory for that area again is massive. It's just about tapping into that. But you've seen where places like China have gone, and especially during the pandemic, when people are being almost forced to use online services much more than they might have in the past. Late adopters have had to sign up to various online grocery deliveries, websites and things like that. So the pandemic has really accelerated the trend, which would be great for India as well. It's just about tapping into that potential and making sure that it can go as far as somewhere like China has.
So never waste a good crisis. I'm just getting a time warning, so I'm going to wrap up by asking everyone just to very quickly comment on the one catalyst that they think will reignite Indian investors. So Brad, I'll start with you. What will make your peers have a similarly equal overweight to you and your firm, or the benchmark therefore to follow suit?
What really interests us is the opportunity Indian companies have to be governance leaders, to try to move into that position, to be ESG leaders generally. We think that like I said, we hold the India management teams we've gotten to know in really high regard. We think that they're totally capable of this, and we think pairing a very strong governance position with all of the other great long-term attributes that these Indian companies have would be a material catalyst.
Great. So going in reverse order, Carly, with a succinct, time-conscious answer, what would you say is the one thing that you would like to see?
I think from my perspective and the fund managers that I speak to, the domestic consumption story is, as I mentioned in my previous answer, a huge theme in India, which is due to that large and young population. So I think the catalyst for Indian equities across the board would need an acceleration in consumption. And that can't really happen with a virus looming over people and unemployment levels higher than before, pressure on wages. So at the moment, I think we just need to see that downtrend in cases to increase investors' allocations and be that catalyst to create less uncertainty for the short to medium term.
Okay, and Gaurav, let's finish with you. So a broader adoption of ESG and some return to better domestic consumption when it comes, and kind of lowering in the virus. What else can you add to that in 15 seconds or less?
I think, the rural economy is firing right now despite COVID. I think the only concern today people have is the impact COVID can have in the banking system, particularly in the small and medium enterprises. So, you have a moratorium till August, but the first signs that you get that, there is not a structural problem in the small and medium enterprises, and you're really going to see the markets move. And the signs we are getting is that, given that the government has infused a lot of liquidity in the system, the problem is not as severe as people originally assumed. And I think if any signs that, you have the small and medium enterprises under control, you're really going to see a big rebound in the markets.
Brilliant. Well, thanks so much, Gaurav. Thanks, Carly. Thanks, Brad. I hope everyone has Gaurav, have a good evening. Brad, enjoy the rest of your day. And Carly, enjoy the rest of what's left of the afternoon and evening. So thank you, everyone at India Week as well, for putting this on for us to have a chance to put our heads together on this very interesting subject.
Amul, thanks to you too as well. Really fascinating session, and well negotiated, well navigated across all those time zones. So thank you for all of that. Amul there with that panel looking at equity markets. We're going to talk more a little later, right after this break. We're going to look at private equity and India's attractiveness as far as private equity is concerned, and also venture capital too. We'll get onto that. So stay with us for that session coming up right after this.